So good morning. As I told you guys, we're going to go through these topics that we have on the right here, and we're going to talk about them. And if you have questions, concerns, burning desires, please feel free to ask. I'd be more than happy to answer them. So first, we're going to start with appraisals. Okay. So guys, what is an appraisal? So what would you guys say an appraisal is for those of you who are live with me in the chat right now? What would you say an appraisal is? So Nancy said that it's an estimate. So yeah, an appraisal, I like saying that it's an estimate or an opinion given by a licensed appraiser, okay, as to the value of real property, okay? So as to the value of real property. So let me actually also say this too. So what is the difference between, because I like to go over this too, because, we talk about real estate, we talk about real property, personal property, stuff like that. So I like to tell you also the difference between land and real property, okay? So this right here, that's the earth, okay? For those of you who are wondering, that's my horrible drawing of the earth if we were looking at a big globe, okay? And what I'm going to show you is this. This right here, this little V section, okay? That is considered land. So like you have your trees, your shrubbery, your stuff like that, okay? Your little bush over here, okay? That's considered to be land. So land covers everything below the earth. So you have subsurface, okay, mineral rights, and everything above it, okay, the air and air rights, okay? As long as it is legal, you could sell, lease, and do whatever you want with all those things separate from the land on the surface, okay? Now, real property, just so you know, we're going to do a little drawing here. We're going to add a little house, maybe a little deck off the back. Yep, that's our little house there. That is real property. So real property is the land and all improvements to it. So when we're talking about real estate, real property, that's what we're referring to. So in this scenario, we're saying that an appraisal is basically an opinion of value given by an appraiser as to the value of real property, okay? So now an appraiser, when they now let me ask you this. What is a reason why we would want to get an appraisal? Like what is a reason we would get an appraisal? So like why would we get an appraisal? Why is this going to be a thing? Okay. And I'm kind of touching on a couple different topics here as far as jumping around because I want to get like a potpourri in for you guys. So what is a reason that I would want to get an appraisal? So Neil said for a mortgage. Yeah, so who's the one who says that we have to get an appraisal done for a mortgage? Because that's really interesting, and that kind of touches a little bit on financing. Okay. Yeah, Angela, you hit it right, nail right on the head. The bank is the one who wants to know that. Okay. So, and the reason why the bank wants to know if the if what the value is, because they want to know, okay, if I'm giving money, okay, if I'm giving money to someone and then they're going to use that real property as collateral to repay me, okay, if they're going to use that real property as collateral to repay me, I want to make sure that the value of the property is going to cover what I gave out to them, okay? Because let's say I had a friend, okay? Let's say I had a friend named Tom, okay? And let's say Tom said, Stu, I'm going out to play, to play with a band, in a couple of weeks. And let's say, because we're musicians, let's say me and Tom are musicians, okay? And I have a very expensive guitar. And Tom says, I would like to borrow your guitar, okay? I would like to have that on loan for me, and then I'll bring it back to you. And as collateral, I say to him, well, can I have one of your guitars? And he gives me a 25-cent Mickey Mouse guitar that he bought for his daughter or his son, and he goes, here you go. And the problem with that is It's not going to cover the value of my $1,000 Fender guitar. Okay. What happens is this: it's not an equal trade as far as the collateral is concerned. So the lender's concerned about that. They're concerned about that situation where they're giving out that loan and then the collateral being used. So if you're mortgaging a property, so you as a borrower are giving the mortgage, and we'll talk more about that when we get to finance. What happens is this: you're running into a situation where the bank wants to make sure that amount that you are lending out is being covered by the collateral that is being put up as repayment for the loan. So does that make sense, guys? Right? That's a reason why we would want an appraisal. What's another reason we would want an appraisal done? Okay. There's a bunch of reasons. I could tell you another one that we want an appraisal done. Refinance. Okay. Someone said to figure out the listing price. I would probably do, so here's the thing. I would probably do what is referred to as a CMA, okay? So a CMA is not an appraisal. Understand that they differentiate those two. It's very important. They differentiate those two. So a CMA is not an appraisal. A CMA stands for a comparative market analysis. And what a comparative market analysis is it's a tool that real estate professionals use. So realtors, real estate brokers, real estate agents, they would use a CMA to come up with the listing price. And the reason why is because it's a little more dynamic than that of some other options that you have. It's a little more dynamic than just a static appraisal. And I'll show you when we get into the different approaches to the different approaches that an appraiser has to consider. Okay. So a CMA, you could consider a lot of different things. And usually that's what a listing agent would use for a listing price. But yeah, any type of finance tool, insurance purposes also, if God forbid a house, a building, a structure burns down, we would probably be using a appraisal to figure out, hey, what is it worth? What's the situation here? What's going on? Okay. So that's definitely a time where we would want to get an appraisal too. Now, let me ask you another question, guys. Who does the appraiser give the appraisal to at the end? So they're done. Okay. And they're like, hey, I'm ready to hand in my work to show you what that it's done. Well, who do they give it to? The lender, the owner of the home. So technically, it's whoever ordered the appraisal. And that is the one of the most important things is the appraisal report does not need to be given to the person who paid for the appraisal, the person who ordered it, right? So what happens is this: technically, it is given to in a lending situation, it is technically given to the borrower, and then the lender requires that to be given to the lender. So they're like, hey, you need to show us that so that we can make sure that the home is of value. Okay. So Neil said the OREE rule. Well, not really the OREE rule. And what that is, for anyone who doesn't know, OR gives and the EE receives. Okay. So 100% of the time. Now, when we're talking about that, again, in this one, we really, the person who's just paying for the appraisal is the one who's going to be receiving it. That's the one that the appraiser is responsible for reporting to. Okay. So the final step in appraising is actually reconciliation, where they come up with one value. Okay. But let's talk about the process. I really do want to talk about the process of appraising and how that works. Okay. So an appraiser is going to sit down and start their work. Okay. They're going to identify the problem. Okay. They're trying to find the value of X property for X reason. So people always say to me, Stu, why do you put the reason for the appraisal in there? Okay. Because it is very important and could change the reason for my approaches, okay? So watch this. And I always give this example. My wife, when we first started dating, she owned a 600 square foot beach house, okay? Tiny, tiny beach house, okay? So she was, I'd say, about 4 or 5 blocks from the water, okay? Now, because that 600 square foot beach house was 3 or 4 blocks from the water, it was super expensive, right? It was much more expensive than if I went 15 miles inland and built the house there. But the cost of building it would probably be the same. So if my wife were to get an appraisal, and the reason for her getting the appraisal was because she was looking to refinance and she wanted to figure out what the market value of the property was, that's one thing, okay? My wife would want to know then what is market value. She would want to get as close to market value as possible. Now, if God forbid there was a fire and she was looking to rebuild the 600 square foot home, well, she's not really looking for the market value of it. She's really looking for how much does this cost to repair, reproduce, or replace, okay? So that's why the appraiser is going to identify the problem, trying to find the value of X for X reason, okay? So that is what they're going to do. They're going to identify the problem, and they're going to say, we're trying to find the value of X for X reason, okay? Next, they're going to have to consider, okay? They must consider all 3 approaches to value, okay? So what are the 3 approaches to value, okay, when we're talking about an appraisal? What are the 3 approaches to value? We have the sales comparison approach or the market data, okay? And depending on your instructor, your book, you might have one or the other, okay, depending on how they write it. There's the cost approach, okay? Then there's the income approach. Okay, then there's the income approach. So when it comes to, okay, all these approaches, the appraiser has to consider each one. It's not that he has to necessarily use each one, because that's not the case. They don't need to use each one of the approaches to value. They simply need to just basically consider them. So that's really the verbiage that they're going to use there. They're going to say, we have considered all of these. We're going to use this one over the others because, and that will be in their narrative. They'll put that in their report. So the sales comparison or the market data approach. What properties are we more than likely going to use that for? Okay, what are the typical properties that we will use the sales comparison or market data approach for? A lot of people are saying residential, saying homes. Yeah, absolutely, 100%. So what we're doing there is you are basically using the sales comparison approach for the purposes of appraising a residential home. So if there are residential sales in the area that you're going to be viable, yes, we're going to use that one. And what happens is this. Let's use a little terminology. What they'll do is this. They'll get the subject property, right? And they'll say it's a 3-bedroom, 2-bath, okay? So we'll put 3-bed, 2-bath, okay? And then they'll take the comparable and they'll say, okay, it's a 2-bed, 2-bath. Now, here's the thing. The subject is the one that we are trying to find the value of, okay? The subject is the one we are trying to find the value of. So what happens is we don't know the value of that. That's the whole reason why we're here, okay? So what happens is this. We'll take the comparable and we'll say, hey, is it superior or inferior? In this case situation, it is inferior. So that means that it probably sold for less than what the subject would sell for. So what we need to do is we need to increase the price of the comparable, because here's the thing: the comparables, we know the selling price of that. Okay, We know the selling price of that because it has already sold, okay? So that being said, okay, what happens is this: you never, ever, ever adjust the subject property because you don't know the price. Does that make sense? Give me a thumbs up if that makes sense to you guys. Because again, a lot of people say, oh man, they'll give you a question where they'll say, hey, do you, are you going to adjust the subject, or are you going to adjust the comparables? You always adjust the comparables up or down depending on its relationship to the subject. So now, in the sales comparison approach, so Angela asked, do you only use one comp? So typically they do this. Typically, they will add multiple comparables. So that's a great question. I'm using one comp there because that's all the space I have. But they'll probably use 3 to 5 comparables, depending on how many adjustments have to be made, depending on how many have sold. If there's a lot of homes sold, they'll probably pick the best ones, okay? They'll probably pick the best ones and then go from there. But that's the situation there. And also, too, they have to use sold data. So what happens is there's a little bit of a static approach to the sales comparison approach. Even though this is an official appraisal check, seal of approval, okay, that might not show you the most relevant and up-to-date information in regards to what the value of the home would presently be. Okay, so even though an appraisal is super, super official, sometimes a CMA, because a CMA is done by someone who's not a licensed appraiser, right? Sometimes a CMA is going to offer you more of a dynamic view of what the actual price of the home would be. Because let me give you an example, okay? In March of this year, if I was an appraiser, I would be looking at homes that have probably sold in January that went under contract in December. At that point, the lockdown and the situation that we were in does not compute. It was not baked into the logic of how those people were making offers and purchasing homes, okay? So what happened was, I'm not looking at a dynamic view of it. I'm looking at a static view from a point of time that is further in the past. And because of the rapidly changing market, it might not reflect what is currently happening in March. Whereas if I have a CMA might actually give you a situation where you're going to see the what's on the market, what has expired, and a real estate professional will look at all that and consider that when discussing it with a seller. So when you guys wrote in, hey, they might use this to figure out the listing price, I probably would lean more heavily on a CMA, like a market analysis, than a appraiser to figure that out, because it takes into consideration different things that an appraiser is not allowed to consider. They're not allowed to consider the different prices on the comparables. I mean, the different prices on like active homes, expired homes, things like that, So that is the situation there. Does that make sense, guys? Give me a thumbs up in the chat. Let me know. Oh, I erased too much. Yeah, that makes sense. Makes perfect sense. So let me do this. Okay, and we're going to put our 3 approaches back up because I erased way too much. So the 3 approaches are the sales comparison, market data, the cost approach, and the income approach. So guys, what I want you to do is this. I want you to tell me, okay, when would we use, okay? And Lisa, I'll take a look at your question in just 2 seconds, okay? And let me just get to it because I'm just finishing up writing this in and making sure that we have it so that you guys could see it, okay? So what would happen is the adjustment would be less. So if we were talking about the example I gave you just now, where the comparable was inferior to the subject, we would increase the price of the comparable. Okay, we would increase it because here's the thing: if something's inferior, right? If something's inferior, then what happens is the price would sell for less, right? If something is inferior to something else, then we would assume that it would sell for less, okay? And the subject would sell for more, right? So what happens is we would have to adjust the comparable up. Does that make sense? Let me know, Lisa, in the chat if that kind of sets it up for you. Perfect, excellent. So, guys, what would we use the cost approach for? What would we use the cost approach for? So someone said a brand new home. Someone said special purpose properties like schools, things like that. Okay. Schools, churches, police stations, firehouses. Yeah. And people always say brand new homes. Yeah. And so let me ask you this. Why would we use it for brand new homes, like brandy spanky new homes? Why would we use it for that? Like, why wouldn't we use a market data approach? Right? Why wouldn't we find a market data? Why wouldn't we use a market data approach? Okay. Why wouldn't we do that? So I'll give you the answer, because it would be hard to find. Yeah, Heather hit it right on the nail on the head. There's really nothing to compare it to, right? If I'm building new homes, but here's the thing: if it is in an area where I'm one of 30 developments and everyone's building new homes, and maybe there is sales data to be had. That's why they don't say you always use this, because the appraiser might put in his narrative, typically I would use the cost approach, but the neighborhood analysis is yielding X amount of new homes on the market, so there is enough comparable data that would constitute and validate us using the sales comparison or market data approach. So Angela wrote a great question. What about a home that is now being used as a business? So that is commercial. And if it's now being used as a business and is being rented out, I would say that probably would lean more towards the income approach, which we'll get to in a second. But what happens in the cost approach? So, guys, we identified the properties that we typically use this for. That would be new construction, okay? That would be new construction and any of our special purpose buildings like the fire station, the school, things like that. Okay, so that is the situation. But let's talk about how we do it. What do they do? What is the appraiser going to do in that situation? Okay, what is the appraiser going to do in that situation? Well, here's what they're going to do. They're going to take the property, okay, and they're going to find out what the replacement or reproduction cost of that property would be. And then what they're going to do is they're going to find out what the depreciation would be. So let me ask you this, because we depreciate the building and the improvements. We never depreciate the land in the cost approach, okay? So when it comes to the cost approach, what are the three forms of depreciation we could have? I'm going to write them over here, okay? So 3 forms of depreciation. Go ahead. Let me know what those are. So we have economic obsolescence. Okay. We have physical deterioration. And then we have functional obsolescence. Yes, we have those 3: economic obsolescence, physical deterioration, and functional obsolescence. So what is functional obsolescence, guys? What is that one? Let's start with that one to start. A beeper. Yes, I think say a beeper would be functional obsolescence. So the functional is not going to be outside of the property. That would be 4 bedrooms. Nancy hit the nail right on the head. 4 beds, 1 bath. It goes to the function of the home. Would this be what I would, how I would build a home right now, today? So maybe it's a narrow staircase, like that's the situation. Like I'll give you a perfect example. My home was built in the 70s. The closets are very small, okay? Very small closets. My wife reminds me of that all the time. And what I'll tell you is this: it is what I would call functional obsolescence, okay? So there would be a deterioration, a depreciation factor built in for that. So the appraiser would say, hey, that's not how we would build closets nowadays. So that is functionally obsolete. So there would have to be a depreciation factored in for that, okay? Small ceilings, sure, absolutely. Yeah, depending on where you are in the country would dictate the situation where yeah, the height of the ceilings, things like that. Depending on where you are in the country, you might have very short or small ceilings, depending on where you are as far as when they constructed it. Okay, then you would have situations where that might be functionally obsolete. We won't build homes like that. Like a lot of the turn of the century homes, those were built much differently than what we would have now. Okay. And you go to parts of the country like South Carolina, where you have homes that were from the Civil War era. A lot of them are built in ways that you just wouldn't build homes today, So you would have to apply a lot of depreciation factors for the functional obsolescence of it. Economic obsolescence. What's that, guys? What's that? Those are things outside of the home. Yeah. So outside the home, uh, yeah, there's definitely a really a bad area around you, stuff like that. Usually, noisy dog. Yeah, those would be all economic obsolescence. Okay. But here's the thing: noisy dogs probably wouldn't be one of them. It would probably be something more on the fact that you could actually verify, so that an appraiser could actually look at it and say, "Oh, that is economic obsolescence." So, train tracks behind you, stuff like that. That would be economic obsolescence. Okay. Also called external obsolescence. Yep, absolutely. That's definitely a synonym for it. An airport within like a mile, 2 miles of the property. Yeah, it's causing you have the noise from the air traffic, right? And what is that physical deterioration? What's physical deterioration, guys? Wear and tear, the siding falling off, leaky roof, leaky gutters. Physical deterioration is that wear and tear, okay? So it's basically saying, hey, look, this is a situation where you're going to have the leaky roof, the leaky gutters, things like that. Absolutely. So we've identified what type of properties we're going to use for that. Okay, we've identified the situation as far as what kind of what are the different types of obsolescence, depreciation, excuse me. Now what I want you to do is this: I want you to type in the chat what type of properties we would use the income approach for, as I sneeze and get a tissue. So bear with me 2 seconds, because literally I'm about to sneeze in 30 seconds. So I'm going to mute myself, get a tissue. But right in there, what would we use the income approach for? Okay, 2 seconds. Sorry about that, guys. So someone said bless you. Thank you so much. That's the problem with being live and recording this is you sit there, you have situations like this. So a couple of you guys said commercial properties, anything that produces an income. Be careful with giving that blanket statement of anything that produces an income, okay? Be careful with that blanket statement because I don't like that as a statement, because here's the thing, okay? If I have a residential home, so Sarah said vacation homes, right? So if I had a vacation home, okay, and I happen to be renting it out, okay, would the income approach still be appropriate, or would we use the sales comparison approach? I probably would use the sales comparison approach, even though it's producing an income. So understand this. I'm actually going to give you a couple of examples of why we would use that one approach versus the other, right? So here's what happens. The reason the income approach exists, okay, and I want you to understand this. I want you to picture the commercial properties around you, okay? I want you to picture the commercial properties that are in your area, the strip malls, the things like this, that, and the other, okay? Those strip malls are all very different. So if they all were to sell, let's say crazy world, we sell all the strip malls in your area in one weekend, okay? Then what happens is this. The situation is they would all still not really be super comparable to one another. So we really wouldn't be able to use the sales comparison approach. The cost approach wouldn't be the best approach to it, because what happens is the cost approach is really trying to figure out, we really use that when we're going to be like insurance purposes, because why is the only reason that we're going to really have to appraise a school, a church, a firehouse? Typically because we have to figure out what it is for reconstruction purposes, okay, because of a fire or damage to the property in some manner, shape, or form. The income approach, we want to know the market value. So what happens is this. The situation is that the income approach, okay, we are going to use either the capitalization rate or the gross rent multiplier, depending on what the appraiser thinks is the most appropriate approach. So that's all totally, completely up to them. That is their opinion. That is their thing. They get to decide what they're going to use, how they're going to use it. Now, that being said, that is typically appraisals in a nutshell. So what I want to do is I want to cross it off our list as far as what we have accomplished today. So guys, do you have any other questions on appraisals before I keep moving and grooving? Right? Anything? Bueller? Okay, everyone. Yeah. Wording on a test. In regards to what, Tom? Like, is there such thing as a non-appraiser? Like a scenario would be, it really depends. They probably would give you a scenario, Tom, in regards to describing a type of property that was being appraised, and they might say, what is the best approach to use? Okay. They also will ask you, they'll give you scenarios as far as depreciation, where they'll give you a scenario as far as there's an airport behind the home and the flight patterns just changed. What type of depreciation is this? Or the property suffers from, they'll say physical deterioration. They'll give you some wonky answer, and then they'll have economic obsolescence in there. You would have to say the property is affected by economic obsolescence. So they would usually give you scenario-based questions where they will give you some sort of situation. And that's why what I do is, the way that I teach is I give you scenario, okay? And here's the thing, you guys are saying, hey, they trick you. Listen to what I'm going to tell you. You have to listen to what I'm going to say. They do not try to trick you. You might think that I am lying to you. Listen, I am in the same canoe as you, okay? I am trying to get you to the place that you need to get to, okay? However, what I'm going to tell you is they're not trying to trick you, okay? I have seen students answer questions that are as easy as, what color is the black cat? And they go to the question and they answer it orange. And then when I say, hey, why did you answer orange? They said, they're trying to trick you. It's a trick. It's not that straightforward. And I'm like, palm to forehead, it's one of those situations where if you answer a question like that, that's super straightforward and get it wrong because you come to the test with the predisposition of they are trying to trick me, then what will happen is you will get questions wrong just because you're trying to find the trick or the twist. And it's not a riddle, it's straightforward. So if you come to the questions and you approach them with that mindset of, hey, they're more straightforward than I think they are, that is the situation with the test. You will be more successful than not. So the test usually asks who can be paid for an appraisal or if a broker can do an appraisal based on a predetermined value. If you do not have a license, okay, if you do not have a license to appraise, you cannot appraise. It would have to be a CMA or a BPO. And a BPO stands for a broker price opinion, which is typically a paid CMA. So in certain circumstances, a bank might pay for a BPO versus a full-fledged appraisal if they don't need a full-fledged appraisal. Okay, so that's the circumstances there in regards to that. And Tom said, I saw questions on where they ask you to find or don't find deterioration. I don't really understand the question, Tom, but if you could clean that up, I'd be more than happy to answer that as we move on. So because deterioration is wear and tear. So either there's wear and tear on the property or not. So physical deterioration would be that. But let's keep moving and grooving. All right, shall we? Okay. So like which example would deterioration factor in? So basically what they're trying to do is figure out which example is going to be physical wear and tear. So they probably give you examples such as one would be functional obsolescence. Like they'll say the home has 4 bedrooms, 1 bath. Okay. It has outdated plumbing. Okay. Because here's the thing, and keep in mind this, I'll give you another kind of hint for the test. The difference between functional obsolescence and physical deterioration, functional obsolescence is that it is functionally obsolete. It is a library in 2020. Okay. Physical deterioration means that it has physical wear and tear. So watch this, okay? I'm going to refer to just the plumbing, and I'm going to give you 2 examples. One will be physical deterioration, one will be functional obsolescence. First one, plumbing is outdated. That means that we wouldn't build the plumbing the way that it's built today. That we wouldn't do that, okay? We wouldn't use that method, okay? Next one, and that will be functionally obsolete, just so you guys know. The next one, the plumbing has rusted and the pipes are wearing down, physical deterioration. Whether it's outdated or not, we don't know. But in that scenario, that is 2 examples where I'm using the plumbing, and one is an example of functional obsolescence. The other is an example of physical deterioration. So that is the situation there. So I hope that clears it up for you guys. So let's go on to the contracts portion. Let's go on to the contracts portion, shall we? So contracts. Now, what are the legal? Actually, I'm going to refer to it as the essential elements of a contract. What are the essential elements of a contract? Okay, and I always tell you guys that that's clock without a K. Clock without a K. Competent parties. Offer a legal object. Offer and acceptance. And consideration. And I always mark this as good or valuable. Okay, so that could be for love and affection, or it could be something of value, depending on what it is. Okay, so let's talk about each one of these. When I say competent parties, I mean they have not been declared legally incompetent by any court, okay? If you are declared to be legally incompetent, then what happens is you can never sign a contract, okay? If the court systems say, nope, that person is legally incompetent for whatever the reason, don't know, doesn't matter, okay, irrelevant. If they are legally incompetent, they cannot sign for a contract ever, ever, if they are legally incompetent. If you are otherwise competent but incapacitated at the time, okay, or inebriated, in my legal opinion, the contract is voidable. And we'll talk about voidable, unenforceable, all that kind of stuff, okay? So we'll get into that, okay? Because what happens is there are various different examples of each one, and I want to kind of go into each one with you guys. So we'll talk about that when we talk about the status of contracts, okay? So you need to have legal object. If I said to you, hey, sell this bag of crack cocaine for me, illegal purpose, right? We can't have that. Or if I said to you, hey, I'd like to buy your house, legal purpose, okay? With 5 pounds of heroin, nope, illegal component. We can't have that either, okay? So what happens is we have to have legality of the object, and all components have to have legal aspect to them. Now, the next one is offer and acceptance. This is also referred to as a meeting of the minds, okay? Basically, we all have to agree on the terms. We have to go, yep. Like, you ever see those Martians on Sesame Street? That what are, I don't even know what they're called, but the ones that go yep, nope, so we have a whole bunch of yep. That's how I always remember it, and everyone's laughing because you remember them, and no one. And actually, you know what? I'll give you extra credit if you could tell me, did they actually have names of them? Like, were those aliens? Did they have names? That would be extra credit if you could tell me, because I'm actually curious now, because I don't even remember if they did have any names. There was Bert and Ernie, and then there was, these guys that just sat there, and they made me laugh more than anything else. So with that being said, does the Swedish Chef count? The Swedish Chef always counts, okay? And consideration is always going to be good or valuable. So good or valuable consideration is going to be something that you're going to get in there as well. And guys, I know that you look, I'm going to tell you something that they're called the Yip Yips. Okay, that's interesting. Thank you for that. And what I'll tell you is, now I know that. What I'm going to tell you, because I'm smiling right now. I don't know if you could tell. I'm laughing. So Angela, you have a fantastic question. I'm going to get to that in a second, but I want to finish my thought as far as your study habits and what you're doing. So you see how I'm laughing with you guys, and I throw in a little humor every once in a while. And if you guys have interacted with me in any manner, shape, or form, whether it's on Prep Agent, in my Facebook group, anything like that, then humor, I'm just one of those guys that I love my breaks, my injecting humor into this stuff, because this is dry, boring, crazy stuff. If you're studying and you have 3 kids and one of them says, hey, mom, can we go to the park? Get up, go to the park, put it down. If you're literally distracted, like you're seeing something, like, I'll tell you this, if I'm sitting here in my office and I'm studying for, like this, I'm writing a lecture, I'm preparing for a webinar, what happens is this: I always tell you guys that I want you to take the breaks. Okay. They help. That's why I inject a little humor into everything. So Tom, you can share that in the chat 100%. I'm sure everyone will get a good laugh out of that. I'm going to keep moving and grooving on this one. But so Neil also said, we haven't heard your dogs today. Yeah, they're quiet. And I also got a new computer that actually mutes my background noise. So I don't know if you'll ever hear the dogs again. They're still there, though. So that's the situation. But anyway, consideration, that could be good or valuable. So what I want to tell you now is this. I want to talk about the status of contracts, like what we could have as far as the different types of contracts, okay? So you could have an implied or express contract, okay? You could have a unilateral or bilateral contract, okay? You can have an executory, okay, or executed contract. So let's take a look at this. So Tom said, I'm a PE teacher, did a scavenger hunt with the kids, found the letter B. Student first grade bought a Corona bottle. So B is for bottle. Yeah, that's definitely funny. I definitely, you know what? I chuckle at that. That's really good. That's cute, innocent stuff. That's a good one, Tom. I like that. So talk to me. What is an implied contract? What is an implied contract? Handshake? Okay. Yeah. Well, yeah, I guess a handshake could be that. Okay. An implied contract is not necessarily verbal, okay? Um uh, so an implied contract, okay? Understand this. I'm going to make it very simple because a couple of you are putting out express contracts, okay? An implied contract is understood through action, okay? When I sit down at a restaurant, we don't need to go over at the beginning the order of operation as to what's going to happen. I sit down, I order my pancakes at IHOP. I'm like, make sure you make the clown face with the whipped cream and the strawberries. Okay. And they know that they're going to bring that out. I'm going to eat it and then I'm going to pay at the end. That is an implied contract. At no point do we ever express the terms of the contract. Never. Okay. It is understood through the action of sitting down at the restaurant. Okay. Now, an express contract. So those of you who know me know I collect fountain pens. Let's say I sit there and I say, hey, I'll sell you one of my fountain pens for $200. And you're like, that sounds like a fantastic deal, Stu. I would love to do that. Great, fantastic. The express contracts do not need to be in writing. They could be oral. We could literally orally get into that contract, okay? I have taken my wife. If you've been in any of my webinars, you probably have heard me that I've taken my wife to a pen convention. The last one I went to was in January of this year, and then everything locked down. So I went to a pen convention, and there were a lot of times where I would sit there and say, "Oh, I'd love to buy that pen," and we were negotiating, we were wheeling and dealing. You know, I was meeting people. I was, and my wife said the nerdiest room of human beings that she has ever been in the presence of, and she went to an Ivy League school. So I sat there and I said, that's awesome. I'm glad to be a part of that, and I can introduce her to that. So those would be express contracts where we sit there. That would be situations where those would be express contracts. So anytime the terms are clearly defined, so Neil put in a lost dog notice, the terms are clearly defined. That would be a unilateral express contract because what happens is it's an option contract and the terms are clearly defined. You bring me Mr. Yip Yip and I will give you $500 as a reward, right? So that is clearly where you're going to go with that as far as, the whether it's express or implied. So implied, understood through actions, okay? And expressed, the terms are clearly defined, okay? So next one would be the unilateral and bilateral. So tell me what a bilateral contract is. I kind of went into a little bit of what a unilateral contract is. Tell me what a bilateral contract is. Yeah, I like promise for a promise. So, okay, let me talk about it a little bit because some of you guys are putting a couple things in here. Someone said it's agreed by both parties. Let me tell you this. It's something that a bilateral contract is going to be one in which there's a promise exchange for a promise. So examples would be, hey, I want to sell you my fountain pen for $200. Me giving you possession of my fountain pen, you giving me $200 is an example of a bilateral contract, right? We have one promise in exchange for another promise. So basically, here's what I usually say. I say, I do this, you do that. That is bilateral, okay? Unilateral is, so tell me what a unilateral contract is. I don't want to steal your thunder, guys, because I see you typing in the chat. I see you participating with me. So why don't you tell me what a unilateral contract is? Lost dog. Yes. It's a one-sided agreement. I like that. It's one promise. One side has to agree to it, basically is bound to it, right? And so usually it contains a word or, okay? So like you could buy my house or you could not. Totally up to you. Up to you what you want to do. I'm bound to whatever decision you make, okay? Now, I'm going to go into something because this has apparently been a question, okay? And I have researched it and I have done my homework. So apparently there is a question. There is a question on the test that asks if an option contract has to be in writing. Okay? So what do you guys think? Does an option contract have to be in writing? Yay, nay, maybe so. Yeah, option contracts do not have to be in writing because here's what I'm going to say to you. I'm actually going to say what an option contract literally is in legal terms, okay? So listen up, perk the ears up, okay? An option is a promise which meets the requirements for the formation of a contract and limits the promisor's power to revoke an offer. So I'm going to put that here because I really like it as a definition of an option, okay? So, and let's put that there, okay? And let me erase economic obsolescence. That's over in the corner there. So an option contract is a promise which meets the requirements of the formation of a contract and limits the promisor's power to revoke an offer. So basically, it like just keeps an offer open. And so here's a couple buzzwords for you guys as far as option contracts are concerned. If there is an option contract and the option E, so here's your OREE rule. Optionor gives the option. They're the one that's bound to perform, okay? Option E is the one who has the option to perform or not to perform, okay? So situation is this, okay? Situation is that you have an option contract. So an option lease is an example. That's what Tom asked. So here's what I'm going to tell you. An option lease is going to be a situation where it is an option. It is a lease with an option to purchase. So they're actually two separate things. So keep that in mind. That's why they actually use the terminology. They typically won't use the terminology option lease because it's not the lease isn't an option. Okay. It is a situation where it is a lease with an option to purchase. Okay. So that's the situation there. And once an option is exercised by an option E, okay, then what would happen is this, okay? Then you would have a situation where it would become a bilateral contract. And once it's a bilateral contract, okay, then you would have a situation where you would have to figure out how you want to get that contract in writing, because now you would have to typically have that in writing if it's an option to purchase, okay? So Angela said rent to own. So there really is no such thing as a rent to own. It's a lease with the option to purchase, okay? So if they exercise the option, then they purchase it at a certain price, and that's the situation right there, okay? So it's a lease with an option to purchase, okay? Because it's usually always written like that. So let's go on to executory or executed. So what's the difference between executory and executed? One is in the process, the other is done. Yep. Okay. So what happens is this. Executory is basically in the process. Executed means that it is done, donezo, over, sayonara, see you later, have a great one, so long, have a great day. Okay? So that is implied expressed, unilateral bilateral, executory executed. So every contract we could identify as being one of those things. So a contract is either express or implied. So let's look at you buying my fountain pen again. Okay. That is an express contract because we understand that we understand the terms clearly. They are clearly defined. It is bilateral because it is a promise for a promise. Okay. At the time that we agree on it, it is an executory status. And once I have my beautiful new fountain pen, it is executed. So that would be called an express bilateral contract. So is a for sale by owner a unilateral status? That was what Lisa asked. So in regards to whom? To a prospective purchaser, okay? To a prospective purchaser? Not necessarily. It's not a unilateral contract because if I put my house up for sale, okay, if I put my house up for sale, someone could offer me something, but that doesn't bind me to it. So this isn't a unilateral contract. You know, marketing something for sale is not a contract, okay? Right? Because, you know, how many times do you negotiate things? How many times do you say, I just want to see if I could get something for it? Because you know what? Here's the thing. Like, do you know how many times with my fountain pens, my wife says to me, you know, why don't you sell some of your fountain pens? And I go, rah, rah, robble, robble, robble. So I begrudgingly go onto like Facebook Marketplace and I'm like, all right, I'll put my pen up for sale for $700. I'll be like, if I get someone at 700, then I'll sell it. If not, you know, then I'm not selling it. So what happens is, what if someone says to me, I'll offer you 700? And I'm like, robble, I think I'll just hide it from my wife. Then I could do that. Okay. It is not an obligation for me. Now, here's the thing. I would be a jerk if I did that. However, there's no obligation on my part. It's not like a unilateral contract because a unilateral contract binds the optionor. Okay. It is different from putting a lost dog poster up, which we identify as a unilateral contract. The lost dog poster is basically saying, hey, if you bring me Mr. Yip Yip, I'll give you a reward of $500. That is a unilateral contract that would be binding to the optionor, okay? Because then what happens is you're basically saying, this is what I will do if you do this. And you're putting it out there for the world. You know, bring me Mr. Yip Yip and I will give you $500, okay? Then what happens is when you go there and they do not give you $500, you could pursue them and say, this is a unilateral contract. Now, I don't know anyone who would do that, but that is what you could do. So let's talk about a couple other things. So did that make it clear for you, Lisa? Let me know. Okay, so next one, we're going to talk about void, voidable, unenforceable, and valid, okay, / enforceable. So if a contract meets all of the essential elements of a contract, it is said to be valid and enforceable. That's the easiest one. Everyone always gets that, okay? Now, I will tell you the other one that's very easy to identify, okay? The other one that's very easy to identify is void. What makes a contract void? Okay, so some people are putting down minor, okay? So here's the thing. Nancy said it's lacking one of the four things. So it's actually it's actually lacking, okay? It's actually lacking legality of the object. Because here's the thing, if it's missing one of the things, like let's say we don't have offer and acceptance, it wouldn't be a void contract. It's simply unenforceable. It's not valid, okay? It's not that it's void. Void means not purchasable. Like, you couldn't go forward with it. There is no way you could act on this, okay? So buying a house with crack, yes, that would be an illegal component, 100%, Lisa, okay? So that would make it void. Also, if you're saying, hey, I know that you're in college and I have this crack cocaine over here, maybe you could sell that for me and I'll give you a cut, okay? That is illegal. It will be void, okay? So you guys say a minor. So here's what I'm going to tell you. California is right now the only state where it would be void to have a contract with a minor, okay? Because they have law on the books and they have precedents based on certain cases that have been adjudicated. So that is the reason why it's void in California. However, it is not illegal to enter into a contract with a minor unless there is an illegal component to it. So like, let's say, here's the thing. Let's say there was a 16-year-old artist that that I went to a pen convention, because here's what I'm going to tell you. There was a lot of like art students and people at the fountain pen convention. And a fountain pen convention. So what happens is this, a lot of younger people there. So let's say they saw one of my pens in my collection and I was like, oh yeah, I'll sell this to you. That is perfectly fine, because 16-year-olds could buy fountain pens if they have the money. Like, they could do that, okay? But if I had, if I went to a tobacco convention and we had the tobacco all over the place, and a 16-year-old came in and said, that smells like some good tobacco, then no, you couldn't buy that, because it is actually, in fact, illegal for a minor to do that, and it is an illegal object of the contract. So it would be void. Now, what makes a contract voidable? Guys, type in the chat, what makes a contract voidable? Duress, right? Duress would definitely be one. Undue influence, right? If you're, 5 sheets to the wind, a minor, unless emancipated, yeah, absolutely. So if a minor's emancipated or married, they're said to be, because here's the thing, drunk, 100%, 100%. If they're drunk, here's the thing. So I was actually alluding to the fact that I was saying this earlier in the class. I was saying, hey, if someone is declared legally incompetent, then they could not ever agree to or consent to the contract, okay? But if someone was simply drunk, incapacitated, stuff like that, they could definitely consent to it at some point, okay? Because here's the thing, if I had a drunk person at the fountain pen convention, like, they could void the contract because they were incapacitated at the time. However, if they come to and they're like, yeah, you know what, I still want to buy your pen, then fine, absolutely, we have a legal valid contract, okay? So minor, duress, things like that. So now we get to the hardest one. We get to unenforceable. So what is unenforceable? What is unenforceable? Unenforceable, just so you guys know, this is the hardest one. That's why I'm not getting a lot of whatchamacallit. Yeah, Lisa, oral contract to buy real estate. So what an unenforceable contract is it's said to be valid amongst parties, but can't be enforced by the courts. So the classic example is an oral contract to buy real estate, because the statute of frauds says that contracts to buy or sell real estate must be in writing. Now, when you're looking at unenforceable, okay, the statute of fraud is a law that says that certain contracts must be in writing to be enforceable, okay? So what happens is this. The statute of frauds says that the contract of sale for real estate must be in writing to be enforceable. Leases over a year must be in writing to be enforceable. Does that mean that me and you cannot enter into a contract orally to purchase real estate? Okay. Then the situation is this. Okay. And guys, I see Sarah said something about the audio. Is anyone else experiencing any audio issues? No? Okay, perfect. So Sarah, that might be on your end and should come through perfectly clear on the recording. So maybe pause. Maybe you could jump out of the Zoom call and then jump back in. I'll let you in. But that's the situation there. That was like isolated situation there, or you could keep going because it seems like it's fine on. So one other person is saying yes. Seems like we're good on the audio. So now that we got that, let's talk about the statute of frauds. Because like I said, it says that real estate sales contracts must be in writing to be valid and enforceable. Okay. So if we had an oral contract to purchase real estate, the courts would say there's nothing preventing you from going forward with that because it's not voidable. Right? Because if all parties, if one of the parties were able to void it, we would say the contract is voidable. Okay. If it was a contract that was for an illegal purpose, we would say it's void. In this case, we're saying, hey, it's not voidable. It's not void. It's simply unenforceable, meaning that the courts cannot force anyone to go forward with it. But what happens is this: they can go forward with it amongst the parties. It's said to be legal amongst parties, but not enforceable in a court of law. Does that make sense, guys? Give me a thumbs up if that does. And then we'll cross off contracts. So, Kim, tell me what we're missing on that one. Tell me how I could help clear that up for you. Because I want to make sure that you guys get this information and that you understand it. Because like I said, you guys with me are the most important thing in the world. So, tell me how I could clarify it and where I lost you, because I might have lose. I want to make it very simple. The simplest way to make it easy is this: an unenforceable contract is enforceable amongst parties, but the courts cannot enforce it. They cannot force you to go forward with it. That is the simplest. That's why I said it's the most difficult one to understand, because there is not a simpler way to explain it. That's the thing. So it is more complicated than the others, right? But not easier than but there is no easier way to go about it. So let's cross that off and let's keep going on. So another one that you guys asked for is debits and credits. Okay. Debits and credits. So I'm going to go a little bit into debits and credits. Okay. So what is a debit? What is a debit? What is a debit? This is a charge for money owed. Okay. A credit. Okay. A credit is the opposite of that, right? So if I get a credit, okay, credit is money owed to you. It's a positive, okay? So when we're talking about debits or credits, there's a couple of things that we have to understand, okay? If there's two words that we usually use, okay? Paid in advance and then paid in arrears. What does it mean to pay something in advance? What does that mean? What does it mean to pay something in advance? So upfront. So let's say this was a 2020 timeline, okay? So this was the whole year. You pay right here for the full year, okay? So that means that it is paid in full, okay? So that's advance. And I'll put ADV there, okay? Now, what does arrears mean? What does arrears mean? We'll do another 2020 timeline. It means that you pay all the way at the end, so December 31st, for the preceding year. So now here's what happens. You ready? And I'll give you a little hint with this. So on the closing disclosure, so we're going to see debits and credits on the closing disclosure, okay? So that's when they're going to come up. They're going to come up on the closing disclosure. Okay? So basically, we're going to be outlining who gets what. And one of the main things that people get, okay, you ready? One of the main things that people get is this. They get, the seller is going to be credited the sale price. The buyer is going to be debited the sale price. Like that's literally, if nothing else happened, that would be the situation there. We would have the buyer owes the seller the full amount, okay? The buyer owes the seller the full amount, okay? And then what would happen is this. We would have to basically just make sure that we came to the table with all that money and the seller will walk away with all that money. But that's not what happens in the real world, okay? So I know that there are going to be at least some debits or credits, okay? So situation is this, okay? When we come to, when we come to the advanced and arrears, let me show you what happens in each one, because you can actually take it to the bank as far as what the scenario is. So we typically have a situation where if the seller has paid in advance, okay, so watch, they have paid through the full year, so they paid here. What happens is if the closing takes place here, then they have to get credited, okay? So you would credit the seller, debit the buyer for the time that they're going to be in the property till the end of the year. Does that make sense? Because think about it. If you paid in advance, then whatever time the buyer is now going to take up that you've already prepaid for, you have to get back at closing, right? So if the same thing happened at closing, so we close here, now the buyer has to get credit because the seller hasn't paid yet, okay? The buyer has to get credit for what part the seller used so that when they owe the money over here, they're going to owe the full year, but at closing, they've already been adjusted for this because the seller had already said, here's money back to you for X amount of time that we use the property. Aha. Does that make sense, guys? Give me a thumbs up if like it's clicking, like light bulb moment. Yes, you see, that's what I love to see. Yes. I know that is a great way of teaching it. You have to understand, look, not puffing my chest out, not patting myself on the back. I've spent 13 years trying to figure out how to teach this. Okay. So that's why when I sit here and I try to teach you all this stuff, here's the thing too. I teach this all off the top of my head. So I sit here and I try to give you stuff that I remember from my experiences. So this is a bunch of different things. This is my experience. This is my experience teaching, my experience tutoring. So I'm giving you the simplest way that I know how to remember this, okay? Now, the other thing that I want to tell you about debits and credits that people always get confused with. So remember when I told you that the buyer basically has to pay, okay? The buyer has to pay for the full amount, okay? Right? So they have to pay for the sale price. Now, so let's say the sale price was $400,000, okay? So we're going to debit the buyer that amount, okay? Now, on the seller side over here, we're going to credit them that amount, okay? So the 400 is going to be credited to them. Now, what happens is the loan, the earnest money, all that stuff end up as a credit to the buyer. Why? Because that's like them going around saying, hey, I owe someone $400,000. Could you give me money? 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 Great. Fantastic. So why does it not show up on the side of the seller? Because the seller's already gotten their $400,000. They're not getting additional. So what happens is this. The loan, all that kind of stuff. That is money that is being brought to the table for the buyer. So what happens is they don't need to bring that to the table. Because remember when I told you, I said if it was a world where there was nothing else that happened, the buyer would have to take all the money out of their bank account and come to the table with that, and then the seller would walk away with that. But what happens is this: the buyer doesn't have to bring the full amount of money there, right? Because since they don't need to bring the full amount of money there, okay, what happens is this: they don't need to bring 400,000. So those are all going to be credits to them for the things that they are basically going to be lent money for. Okay. So that is the situation there. Okay. Now let's keep moving and grooving. So this is, and listen guys, what I'm going to tell you is this: that's debits and credits. That's my way of explaining it. That's the best way of understanding it, without doing actual math in regards to how to figure things out, prorations and stuff like that. That I cover in my math chapter, in my math webinars, and I will be doing one for next month. Okay. So Tom asked for where that is in the, Tom, your question is New Jersey specific in regards to what chapter is it in the Dearborn book? I think it's chapter 20 or 21. One of those. It's 20 or 21. Okay. So any other questions on debits and credits as I erasey? Erasey. Questions, concerns, burning desires? Anything, guys? Nothing? Good. So we did the debits and credits. Okay. So next, okay. So what about monthly? Monthly is the same thing. Kim, it's the same thing. So if we're talking monthly, just change that timeline from a 2020 year to, so you're asking how many days in a month. If you're talking proration, you're talking 360 days in a year, 30 days in a month. Okay. So that's a banking calendar. Okay. 360. So someone said, I heard Respa is bigger on the test. We'll go into, you know what we'll do? We'll do financing now. So we'll talk about Respa. We'll talk about TILA. So why don't we talk about Respa? So since you brought it up, Tom, what is Respa? What is Respa? Guys, tell me what that is. What does that stand for? And this is basically would fall under finances. So someone said Respa is truth in lending. So you're thinking of TILA, and I'll tell you, watch. You ready? TILA is the Truth in Lending Act, okay? So RESPA is the Real Estate Settlement Procedures Act. Real Estate Settlement Procedures Act. Okay. So someone said, Angela said, let me kind of read that statement as I make this bigger. Okay, there we go. It is to protect the consumer if they are done wrong. Okay, so what it does is this. It's not, that's a very broad statement. We need to narrow that down a little bit because you're not entirely wrong. Okay. Someone says closing numbers. Nancy says it prohibits kickbacks. Ooh, yeah, it does prohibit kickbacks. What's a kickback? So that is one of the things that the Real Estate Settlement Procedures Act does. So what's a kickback? Giving a gift illegally. So who's giving it to who? Who's giving the gift to who? So I sometimes tell you guys about the buyer to a salesperson. No, a buyer could give it to a salesperson. So I have clients who give me gifts all the time. That's totally fine. And here's the thing: as long as it's passed through the broker, it's fine. Okay. So Lisa said, so I'm talking about RESPA right now. Okay. I'm talking about the Real Estate Settlement Procedures Act. It prohibits kickbacks as one of the aspects of RESPA, or the Real Estate Settlement Procedures Act. Okay. And what we're doing is we're defining a kickback. Okay. So a client giving a real estate professional or a mortgage professional or an attorney a gift, totally fine. That is not a kickback, okay? A kickback would be this, okay? One of my mortgage brokers used to send me bougie cookies. Like we're talking like $100 ooey gooey, wonderful, yummy, yummy, yummy cookies, okay? Another attorney. So here's the thing. If I had an attorney who said to me, "Oh, I want to give you this fountain pen because I know you like fountain pens, and here you go. Thank you so much for closing this deal." They cannot do that. That is a kickback. That is illegal because it is perceived that they are basically saying, "Hey, if you continue doing business with me, wink, wink, nudge, nudge, maybe you'll get another fountain pen. Maybe you'll get another wonderful batch of ooey gooey cookies." Or what about if they said, "Hey, Stu, I know you're a big hockey fan. Would you like to go to a hockey game in this luxury penthouse box?" No, I would not like to. Okay. So that is the situation there. It is when settlement service companies give you some sort of benefit or vice versa. Okay. So what happens is this: there cannot be any type of kickbacks in that manner, shape, or form. So some things that happen that can be done, and I'll actually tell you, okay, is this something that can be done. So a lot of my lenders, mortgage partners, things like that, sometimes they'll rent out a bar and they'll say, "Hey, everyone's invited. We're just partying." So if it's an open invitation and it's not directed at somebody, that's perfectly fine. That's not a problem. That's not a kickback. That's them just throwing a party. Okay. Totally cool. It's open to any broker who wants to come. So they're not targeting anyone. I used to manage a very large team in my state, and my team produced a lot of money in business. So what happened was there was one time where I caught wind of a mortgage broker who said to 3 of my agents, "Hey, would you guys like to go out? We're going to rent a bay at Topgolf." Now, a bay at Topgolf, if you guys don't have a Topgolf near you, it's basically like a golf range Dave and Buster's where there's alcohol, food, games. Like it's just basically like a big adult golf, arcade. So what happens is this: the renting a bay out was not a couple $100 night. We're talking it was a $3,000 to $4,000 night, and I told them that's a no-no. That's a no-no. Like you cannot have a mortgage broker take you out for a $3,000 night. But what happened was they did that kind of business, okay? And what happened was the mortgage brokers were targeting them and saying, "Hey, let's go out to dinner, let's do this, let's have drinks, let's open the bar up," and they're drinking top shelf. And yeah, it got crazy. And I said, no, that's bad. Naughty, naughty. You can't do that. Okay. So that is an example of a kickback, things that would not be considered a kickback. And again, gifts from buyers or sellers, not kickbacks. Okay. Not kickbacks. All right. So let's talk now about TILA, which is the Truth in Lending Act. Actually, let me finish up on Respa because I just talked about kickbacks on Respa and I just realized that. Respa also requires for the clear disclosure of the cost of settlement services. So if it has to do with settling the deal, so closing the loan out, okay, not originating the loan, but closing the loan out. So like basically closing the loan, any type of fees that are associated with that, that would be a part of it. The cost of the attorney, the title company, okay, all those things would be examples of things that have to be on that RESPA would cover. They say, "Hey, you need to disclose these things to said individuals." Okay. Then that is basically RESPA in a nutshell. So RESPA says you have to have a clear disclosure of the settlement costs. Okay. You have to have a clear disclosure of all those things because there cannot be any kickbacks involved and everything has to be clear and upfront. Okay. That's RESPA. Now, think of TILA or the Truth in Lending Act as like the other side of the coin. Think of them as having the same coin, but being a little different. Truth in Lending Act has to do with advertising and the situation in regards to what would trigger any type of advertisement and stuff like that. And Angela wrote a great question. TILA is when you must state the APR info and all the triggers. So what I'm going to do is I'm going to type in all of the triggers when it comes to the Truth in Lending Act, okay? So I'm going to do that in a second once I get to that section of my notes, because I do want to make sure that I give that to you accurately. So what I try to do is I try to look at that in my notes, okay? So that is going to be 261,354. So I'm actually flipping to that page right now because, again, I do this all off the top of my head. And there are some things that my dyslexia like kicks in. And I'm like, oh my gosh, do I have the triggering terms? Do I not have the triggering terms? Okay, all that kind of stuff. So let me show you in my notes, because I have my page open now, okay? Because that's what Angela just wrote in there. Hey, what are the triggers, okay, for when you have to disclose everything? And this has to do with lenders, okay? So if they put the amount or percent of down payment, okay, if they put the number of payments, okay, if they put the amount of any payment or the amount of any finance charge, okay, so those would all be triggering terms. So let me show you in a different font which would not be triggering terms, okay? Not be triggering terms would be over here, okay? So not triggering would be financing available, okay? Financing available, terms negotiable, okay? Just basically like any basic terms, okay? So any basic terminology. So if you put the words annual percentage rate, that would be a trigger too, because that would be the amount of any finance, okay? So if you put annual percentage rate, you do need to add that. So owner may finance, okay? So any of those terms. So Tom, you just said zero down. Look at my triggering terms. Is that amount or a percentage of a down payment? That's a trigger. Yeah. Creditworthy, non. Yeah, creditworthy, like that is not because again, it's not number of payments, it's not amount of any payment, it's not amount of any finance charges, it's not amount of down payment. Okay. That is why when you see a car commercial, okay, when you see a car commercial and they say 0% down, 0.9% APR, and then at the end they go, that's truth in lending. Okay. So that is so that the borrower knows what the true cost of. So yes, so when you're saying this, and I think your name is Brianna, so I hope I pronounced that correctly. So you said, so what I understand is if you disclose one number, you have to disclose all. If you disclose one of these, you must disclose all of them. Okay, that's why you need to have basically clear, transparent cost of lending. That's really what TILA is. Now, there is a third thing here, and I want you to understand what this is, okay? That's TRID, and that's the TILA Respa integrated disclosures. So what we commonly refer to as the closing disclosure, where you would see the credits and the debits and things like that, okay? That would be all under the TRID rules and regulations, because that's when TILA and RESPA integrate, and you have to provide disclosures based on the integration of them, okay? So that is TILA and RESPA in a nutshell. Are there any questions on that? Because that's the simplest way to remember it as far as an explanation for you guys. So let me know in the chat if there's any questions on that I could further clear up before we move on. And we'll go into more financing now. Quiet, so I must have done a good job. All right. Well, thank you. I appreciate you guys. So let's keep moving and grooving, shall we? What we'll do is we'll talk about financing. And what I like to do is I like to tell you how mortgages work. Okay. I like to give you my explanation so that you understand, because I think that everyone always enjoys my explanation of it. It's simple and it helps you understand what certain things are. So, this right here is how I draw a bank. They hold money. Big place that has money. Okay. And here we got a buyer. Buyer says, "Oh my God, I found a house over here and I want money." And the bank goes, "Okay, we'll give you money." And it keeps that nice big smile on their face. Okay. They're like, "Yay, money." And they go, "Okay, I'm going to use that to buy this house." Okay. And the bank goes, "Hold up. Wait a minute. Wait a minute. How do I know that I'm going to get my money back?" Okay. The borrower says, "Oh, I'm going to help you. Watch this. Watch this. I'm going to give you a note." Okay. I'm going to give you a note. And the bank says, "What's a note? What is this note thing? What is this note thing?" So, guys, tell me, what is a note? What is a note or a promissory note? What is a note? What is that? It's an IOU. It's a promise to pay. Yeah, it's evidence of debt. Okay. Love it. Love it. Love it. So basically, here's what happens is the bank goes, "What's this note thing? I don't know what this note is. We just gave you $100,000 to go buy that shack over there. And now you're giving us this note." And the buyer's like, "Yeah, it's like an IOU." And then the bank goes, like those love coupons that my wife gives me on Valentine's Day that say you can get dinner whenever you want or a free back massage. And the buyer's like, "Yeah, it's totally like that. That's exactly what it is. It's an IOU." And the bank's like, "Yeah, that's not good. Like this isn't this is nothing." Like he's like that guy got the hamburgers and Popeye. Yeah. So it's like this. It's like the IOU. It's like so like the bank goes like this. They go, "Look, I still have five of those, I'll make dinner for you coupons crumpled up in my desk drawer. It's like those don't mean anything to me. So you're just gonna give me another one for this $100,000?" And the buyer's like, "Yeah." So what happens is the bank's like, "We're going to need more than that because what if you don't pay me back?" And they're like, "Okay, we're going to give you the mortgage." Okay. And then the bank goes, "What's the mortgage?" Okay. So what happens is this: the mortgage is the pledge of real property for repayment of the loan. So what you're basically saying to the bank is, "Hey, if I don't repay you, okay? If I don't repay you in accordance with the note, what happens is you have this mortgage where you could take my home away for repayment of the loan." So the bank's like, "Yeah, we're totally cool with that. So we'll take this mortgage and this note." And now let's fast forward to another situation. Buyer has gone away. Bank has no mas money, but they have all these mortgages and notes. Okay. They have all these mortgages and notes, and they're like, "Okay, what am I going to do with these mortgages and notes?" This is a predicament because now there's another buyer here and he's crazy too, and he wants more money, but I got nothing. So what happens is this: in order for the banks to stay open and for the banks to exist, they have to find a way to sell those mortgages and notes. So this right here, okay, and Tom, you're on the right track. So this right here is what we would refer to as the primary market. That is where lenders live, breathe, eat, and sleep. Lenders, credit unions, things like that. Those are where they live, breathe, eat, and sleep. So what happens is they would have mortgages and notes, okay, left over, and no mas money. So then they go over here to the secondary market. And here's what the secondary market does. Think of them as sitting here in their Scrooge McDuck vault. So they got the diving board and they're just going right in to their big, big, big pools of money. And the banks say, "Hey, Fannie Mae, Freddie Mac, okay? They're going to Fannie and Freddie, and they say, could you guys do me a favor? Could you buy these mortgages and notes from us so that we could have some of that Scrooge McDuck money, okay, that you have just laying in there, okay? And Fannie and Freddie are like, sure, we'll buy it off you. So let's say this, remember I told you this was a $100,000 note, okay, because that was what they lent out. So they sell it to Fannie and Freddie for, let's say, 105,000, maybe 110. Maybe they do better. Maybe sometimes they do worse. Okay. It depends. Okay. But that's how the banks make money. Okay. They lend out money. And what happens is the money that they actually lend out, let me tell you like a vicious story about how this whole cycle works and why some things break. Okay. So what happens is when you get your paycheck and you put your paycheck into the bank, into your savings account, okay, what they do is because they have hundreds of thousands of people and millions of people putting all of their putting all of their money into the bank. What the bank does is that's actually how they start with money. Okay, they use your savings, okay, to lend out to people. And then what they do is they sell the mortgages and notes for more to make money. Okay. That is why we had the Great Depression back in the day, because here's what happened. I'll tell you a quick story, quick history lesson. Okay. What happened was this, when things were going south, okay, back in the day, everyone said this, I want to go to the bank. I want to take my money. I want to put it underneath my mattress. So then what happened was the banks said this, oh, poo-poo. We need that money. And all the people were like, no, has to go underneath my mattress for hard times right now. Ain't going to happen. So then what happened was that's when everything crashed, because the banks then didn't have money to lend out. And then the banks didn't have any of this stuff in place. So that's why things went south really quick, okay? It is basically a situation where, this is the reason why if everyone were to right now go to their bank and take out all their money because they wanted to touch it, the banks would not exist. It just wouldn't exist. We would successfully shut them all down, okay? So that is the money that they lend out. But again, they replace it by selling the mortgages and notes. Okay. So Tom asked the question, why would Freddie and Fannie pay more than 100,000, like 105,000? Okay. So here's the thing. They're not doing them a favor, because there's two ways to make money off of a mortgage or note. Okay. So if you have taken out a mortgage at any time in your life, okay, on your home, and you've gotten a loan to pay for it, you understand that over 30 years, you are paying a boatload more money than what you think you're paying. Like the interest on it is absolutely phenomenal. Okay. So here's the thing. Fannie Mae and Freddie Mac, if they're willing to sit there for 30 years on this note and this mortgage and have it fully paid off, they're making a boatload more money than the $5,000 additional. Okay. So what happens is this: they basically are making much more than the 5,000. Okay. So what happens is, and they have to give the bank something usually, okay, to pay for that, because again, the banks aren't in the business of, hey, I want to lose money or break even. So what happens is Fannie Mae, Freddie Mac, they're going to sit there on the secondary market. They're going to buy those mortgages, those notes, and they are going to give that money to the bank to replenish it. Okay, that is how that works. And then the bank has more money. They get rid of the mortgage and note. Okay, and they start the cycle over again. Okay, and now Fannie Mae, Freddie Mac, what they do is they sit on the secondary market and then they sell to investors. That's how they have Scrooge McDuck money. So they're not government entities. Understand that. They are not government entities, meaning, yes, they are. Listen, the government will not let them fail, meaning that it will be a cold day in hell before Fannie Mae or Freddie Mac bellies up, because bottom line is that needs to, in this whole system, all the cogs in the wheel need to work. Okay. So what happens is Fannie Mae, Freddie Mac, they just sit there, they buy up those mortgages and notes. Okay. And then they're backed by investors. They're saying, hey, look, we have some reliable investments because we're going to make a lot of money over 30 years. And this is reliable as opposed to gambling in the stock market. So people with a lot of money give Fannie Mae and Freddie Mac a lot of money. Okay. Because they're like, okay, yeah, I know my money's going to come back to me. Okay. So now there's a third entity on the secondary market, Ginnie Mae. Okay. So Ginnie is the government entity. Now, remember when I told you, I said the government entities do not purchase anything. They do not fund. They do not do anything because Fannie Mae, Freddie Mac are the entities that buy. So what does Ginnie Mae do? So Ginnie is our government entity that basically kind of convinces Fannie Mae and Freddie Mac to buy lower quality or higher risk loans. So think about this. Fannie Mae and Freddie Mac, okay? Fannie Mae and Freddie Mac are going to be someone who is going to cover purchase those mortgages, okay, and those notes. And what happens is they don't want to buy any of the higher risk loans. Okay. So what happens is this. Ginnie Mae goes in there to, if any of you have kids where you have to hide the vegetables in like the mashed potatoes, basically that's what Ginnie does. That's her job, is to go onto the secondary market and to basically give Fannie Mae, Freddie Mac incentives in the process of whatchamacallit, in regards to the process of like they sell pass-through certificates. You don't need to know. So on the test, so listen to what I'm going to tell you. In regards to the test, typically there's not a need to know situation in regards to how much detail you need. So Ginnie is the government entity. She was created in 2008, and she basically helps and incentivizes Fannie Mae and Freddie Mac to purchase higher risk loans. So Elizabeth asked a great question. Will we be able to go over all of the topics? The answer is, with the quality that I'm giving you guys today and the amount of time we have left, I am going to go a little over the past 12 o'clock. So what I'll tell you is this. I just don't see us getting through everything, okay? Because like I said, we kind of went into a little more detail than I usually do with some of these topics. So I will answer any questions that you guys have. So if you do have a question, Elizabeth, on any of the things that are left over that I haven't touched on, feel free to type it into the chat and I will try to answer it. But it looks like I won't get through all of them, okay? So I will go into agency next because I think that there is a lot of stuff in agency that you do need to know. So I think that's where we'll probably end up wrapping up, because I went into finance. I went into for primary and secondary markets, which are questions that you guys usually get because depending on your teacher and what they go over, sometimes you get a lot of information from your classes and from your material on that. Sometimes you don't. And I always think that I have a pretty good, simple way to explain it. So I like going over that if that's ever something that comes up as far as like what the things I ask you for. And here's the thing. I asked you at the beginning of this, what are things you want to go over? Because I want to see in a perfect world what we could go over if we could get to it. So we did do financing, right? We covered financing. So now let's hit agency. So agency. And we're going to talk about the general law of agency. And I'm going to switch to blue again because I think that's a little easier to see. Okay. So agency. What is that? What do I mean by agency? Because the law of agency is what we're referring to there. So what are we talking about when we talk about the law of agency? And Tom, you asked a question back when we were talking about the secondary market. You said, is that warehousing? So yeah, what Fannie Mae and Freddie Mac do is actually warehousing, just so you know. Okay. They warehouse and package mortgage togethers to sell as a product to investors. That's basically what they do. That's how they get investors. Okay. So basically, I like Kimberly had a good one. It's when we represent or work on behalf of a client or principal. So in an agency relationship, there are two parties. There's going to be that of the agent or the fiduciary, and then there's going to be the client and the principal. Now, there's also a third party called the customer. So that is someone who is a party to the transaction, but not your direct client or principal. Okay. So, Tom, what examples do you want me to explain? Just let me know in the chat because I don't want to keep moving ahead if you have a question on that. The ones that are up there. So yeah, so that's what I was talking about just now. So the agent fiduciary is the one who is representing, okay? The client or principal is the one that they are representing. And then the customer is the third party in a transaction that you are not representing. So if your client or principal is the buyer, then the seller would be that of the customer, okay? And vice versa, if you were representing the seller. And now understand this, okay? Understand this, okay? The situation here is the agent or fiduciary is always going to be the broker, okay? Is always going to be the broker, okay? The client or principal is always going to be the person that you are representing. So here's the thing. You are working as a representative of your broker, okay? You're working as a representative of your broker. And the customer, like I said, is that third party in regards to that. So that being said, okay, let's talk about the different types of agency, and then I'll talk about the fiduciary duties, okay? So there are three types of agency. There's universal, general, and specific or special. So universal agency, that is a situation where, okay, the agent has universality in their representation of the client or principal. So the best example of this is power of attorney, okay? Meaning that basically the agent could do a whole bunch of different things on behalf of the client, okay? They could do a whole bunch of different things. They could sit there and go from, signing a lease for them to renting a car to selling their home. They could do anything. So I have power of attorney for my grandparents. So what I could do is this. I could sit there and actually say, okay, I'm going to sell your house today, grandma and grandpa. Okay. Then I could go to the grocery store. I could pay for it with their money. I could go to the drugstore. I could pick up their prescription medication. Like I could do basically anything that they could do, I could do. I have universality in my representation of them. Now, general agency, you have universality within a business aspect. So the best example of this would be a property manager. Okay, a property manager. Because let me give you an example. Let's say I had 15 buildings, okay, and you were managing one of the 15 buildings. What would happen is this: you would have universality in regards to that specific property. You would be managing that building for me, okay? You would be managing that building for me, and what you would be doing is this, okay? You would be basically handling everything. So you would have universality within that building. So you could purchase a van for it if you wanted to. So you could purchase a van. You could fill a vacancy if there was a need for it. Okay, you could do that. You could also, if there was a plumbing issue, a pipe issue, things like that, you could cover that. So you had universality in regards to representation for that one specific building, okay? That being said, you do not have the rights. So what limitations does general have is what Tom was saying. So the limitations are that you can't go out of your scope of the business. So if you are managing 123 Main Street, you cannot represent or work on behalf of the person for the client or principal in regards to their other properties, okay? You can't go out and do things for them in general, like you would in power of attorney, right? So you wouldn't be able to sign for their own personal lease. Like if they had personal things going on at their own residence, like you wouldn't be able to represent them or work on behalf of them in that aspect. Okay. So that's the situation there in regards to the limitations that a property manager or like someone in a general agency has, depending on what type of agency what type of business they're working within. The next one is special agency or specific. That would be a real estate agent for the most part. Okay. So real estate agent, has the authority to procure a buyer for the sale of a home. Okay. It is not their responsibility to call up a plumber, pay for the plumber, do all that kind of stuff if the pipes freeze over and they explode. Okay. Not their responsibility. It is not their responsibility to have someone come and, clean the driveway out. It is not their responsibility to have the grass be cut and do all that kind of stuff. Now, here's the thing. They might help out and they might say, oh, I have a guy. Oh, I could call someone for you. Okay. But that is not their responsibility in regards to their agency relationship. So that being said, are there any questions on that? Okay. Is what I will do now is talk about the actual fiduciary responsibilities. So I use the acronym of COLD, okay, which is accounting, care, obedience, loyalty, confidentiality, and disclosure. Okay. Because I always say if you have an agency relationship with someone, you are close enough to them where you could catch a cold. And some of you say use old car. Nothing wrong with that. Basically, what you're doing is you're outsourcing confidentiality to the C. So old car would be this. Okay. So you're saying, what about reasonable care? So that's what Neil wrote. So watch, I'll show you old car and you'll see where it's the same thing. Okay. It's obedience, loyalty, disclosure, confidentiality, accounting, and reasonable care. So you see how it's just synonyms for one another. You see how it's just switched up. What I do is I imply confidentiality in the loyalty. Okay. In a old car, it's the same thing. Some teachers teach it one way, another teaches it another way. Again, I like a cold. It's nice, simple, and it's the way that I've been teaching it for 12 years. But I know old car. And if you look at it, you can see it's all the same thing. It's just I keep it more concise with the loyalty because loyalty and confidentiality I just think that they're the same thing, in my opinion. Okay. And I don't like the reason why I never did it. I'm actually kind of giving you probably more than I should as far as my thought process, but let me tell you what my thought process is. So what happens is reasonable care. I just didn't like the word reasonable in it because I just felt like care is care. Okay. So Tom asked, can you give an example of what they may ask for one to be an answer? Well, they might ask you which they typically like to allude to or ask you situations in regards to obedience. So it really depends on the way that they word the question. As long as you know what the fiduciary responsibilities are, you should be sufficient in understanding what the situation is and what it's calling for. So Elizabeth asked a question, could you do an example of what the client versus customer is? So that's really simple. The client is the person that you are representing, okay? So that is the person that you owe all the fiduciary duties to, okay? A customer, you only owe them what we refer to as fair and honest dealing, okay? So in regards to a client, if I'm representing a buyer, okay, my fiduciary responsibility is to the buyer. In that situation, when they go to purchase a home, the seller would be considered A customer. So I would only owe them fair and honest dealing. I can't be underhanded or unethical, but I do not owe them any fiduciary duties beyond that. Does that make sense, Elizabeth? Just let me know in the chat if that does. So a customer is someone who is just a party to the transaction that you do not owe fiduciary responsibilities to. So that being said, okay, is the seller a principal to the seller's agent? Yes. If you're representing the seller, okay, then yes. So like if I'm listing a home, okay, so here's what it is. If I'm listing a home and I'm working with the seller, then what happens is I am going to be a seller's agent and the buyer would be my customer. I would only owe them fair and honest dealing. Okay. So, with that being said, what I'm going to do is this. I'm going to stop the recording. Okay. So, this is where the recording will end. I'm going to erasey. So, it looks like we got through agency, finance, contracts, debits, and credits. We got through a lot of things because we did some deep dives. And listen, I'm going to stay on for a couple minutes after I cut off the recording. So as far as the recording is concerned, we are now going to be saying goodbye to the recording. So thank you for sticking with me for this long, and au revoir.